we'll be having the dynamic duo. They're here, the gents, Neo and Lebu, and they're going to be reflecting with us around the workshop that they had over the weekend. And yeah, it was just bantering with them here. You can tell that, yeah, we missed out, right? We missed out, but they're here to really break it down. They're taking us there. It was a packed event over the weekend, and I was just saying to you that this signifies growth, even on your end as an organization, looking at where you started and how you're coming through for those in the property space. Gents, good morning. Welcome to the show.
Good morning, Katlego, and good morning to the listeners. I'm really excited to be here. The only reason we do wake up is for property investing, and that's why we're here today.
They said entrepreneur never sleeps, man, and others would tell you that you snooze, you lose, because then there's money that is circulating as you are sleeping. But I'm glad that, you know, me and you can share those ideas and help position people to also get the best out of these cents. Lebo, how are you?
I'm good, thanks. I was really excited. Hey, it had been a while since we've came.
Yeah,
It feels like coming back home.
That's what I was saying, guys. Please come through. Let's reflect. Also, because I missed the weekend workshop, but I was like, let's reflect and try and get a sense and a breakdown of what happened where this Invest Like a Pro workshop is concerned. And I guess it says it all, right? Invest like a pro. And for you to really become a pro into this space, there's somewhere that you need to start as you go into this journey. And one would say that you need to then understand the space, what you're going into. You'd hear people saying that there are different properties that you can invest in. You'd hear people saying you need to do your research. You'd hear people saying you need to have money, all right, to be able to really navigate this space. Let's talk about these workshops that you guys host and just get a sense of why then you feel the need to bring all of these expertise that you've gotten over time within this space to those people that would want to be investors in this space.
Yes, Katlego. The reason why we started these workshops is that we realized that there's a gap between your buyers and the experts, right? So we actually started a platform whereby we're calling you experts. So this weekend we had guys from SA Home Loans, and we also had guys from Liberty, and we also had another team whereby they're talking about offshore investments. So ultimately what we're doing is that we are saying that let's come through with the experts so that we can create a platform for first-time beginners and people that have already started to invest so that they can gain access to information before they actually buy.
And really, when you look at it, it's positioning yourself, right, for this particular space. Others would say is the unknown. You're walking into this space. If you just take a Katlego, man who's a broadcaster, and you're like, Katlego, we're throwing you into property, thrive. And I may hit stumbling blocks. I may just go into some of the reckless mistakes that could have been avoided as you go into this space. The jargons, I may not even know what to say when I approach certain clients or I go into this space. And really, when you look at where we are right now in terms of this property investment literacy, would you say that you feel that there has been somewhat of a gap over time that will need to be filled? Have you picked up on a lot of people that are interested in going into this space, but they just don't have an idea of how it functions, and they would then see you coming through for them?
Yeah, 100%, man. I think the main problem that we are actually having right now is that most people want to work as an island. I'm trying to grow myself alone, and I do not want to work with other people. And that's where you find that there is a knowledge gap between the two, and that's what we are doing. We are bridging the gap between the knowledge and the people. I mean, I had someone speaking to me in terms when we were doing the meet and greet, if I may, where they were saying that had they known about the FLISP, they would have actually saved around 100,000 on that property. So now, looking at that, there is a gap in terms of the knowledge. Now, we are just coming in to fill that in terms of if someone wants to buy their first property, or if someone wants to go into property investing, which route should they actually be taking, and what knowledge can we actually fill in the gaps so that they can have, I'm not saying 100% smooth sailing, but they can have a better experience looking at property investing.
Is this a lucrative space now that you'd advise one to go into? I mean, you find a lot of people saying they've gotten maybe the monies they would want to invest. You get people saying that I don't have the monies, but I still want to go into that space. Would you say that it's a lucrative space? You'd advise one to go into this space, and how do they go about it? Where do they start?
It's very lucrative, Katleho, and it goes back to the first speaker, which was coming from SA Home Loans, whereby she was talking about how do we get access to these monies. So it's very important that we pay attention to that, because here's the challenge: is that a lot of people just look at how can I get that property and not necessarily pay attention that how do I get access to the funds. So if I should give you an example, is that some people, and even Lebo was in this case, whereby we went to go view a property, and then the property was selling for about 350. And then the estate agent, which is the lady, she was like, no, gents, why don't you just apply for a personal loan or take it on credit, because it's not so much. But then now when you're looking at how much he would have been charged on credit if he didn't understand versus buying it via loan, it was a significant difference. So the lady was rather pushing that you would be done within 5 years, whereas if the average person would be like, yeah, that is a bonus, but looking at how much I would pay back within that 5 years versus taking a home loan, there's a huge difference. So ultimately it is lucrative. And also looking at other financing as well, Katleho, is that we need to be very careful in terms of refinancing. That's what the lady spoke about. So when we're talking about refinancing, we are talking about accessing my equity. So what equity is, I'm hoping I'm not being too technical in the morning.
Come on, man, preach.
We're going for the jabs, man. So accessing my equity is more of, let's say that we had a house that's paid up already. So now what's going to happen is that I go back to the bank and I say, bank, can I access money on that house that I've paid up? So then the bank will then look at your financing and say that, do you afford or not? Now, a lot of people miss this, right? If let's just say that when you applied for that home loan, let's just say that you got a good credit score. So you applied at about, you were getting like about 10%, right? But now when you refinance, now you find out that you did a lot of bad decisions, and now you're being charged at about 13%. You might even find out there's a difference of about 6,000 in terms of how much you were charged. So ultimately, yes, you do have access to it, but looking at it from the interest perspective, you are charged premium.
Yeah, no, it's a lot. So those are some of the considerations, right? And you have to know about these things.
Yeah.
So you're able to do these things. Do we see, you advising people on this, or do you direct them then to people like your SA Home Loans that would be able to really take them through issues of financing, and then, more or less help them with that financing as well in terms of the property that maybe they may have identified?
Yeah. So as an investor, I need to actually sit down with you and give you both the pros and cons. Because if you're going to go to a bond originator, or if you're going to go to SA Home Loans, or directly to that financing institution, the problem is that they need clients. So if they see that you qualify, they are going to sell you on that product, whatever that you went to consult about. Now, as the investor, I need to sit down with you and understand that, does it make business sense? Now, if someone is saying that they want to buy a property for them to live in, say for instance, they're moving towards Johannesburg and they're required to buy a property. I mean, they are forced to buy that property. But now, as an investor, you're not forced to buy a property right now. So what my job is to sit down with you and understand that at the interest rate that you're being charged at, is it lucrative for you to go into that deal? Because now two people can apply for, say for instance, similar property, right? But now one is getting 11.75%, which is the prime lending rate right now. And now the other one is getting prime lending rate plus 3%. So you find out that they are sitting at 14%. Now at 14%, the deal might not make sense. So that's where we come in, and to say, just relax a bit. Let's work on your credit score so that you can get a better interest rate. And once you've gotten a better interest rate, that's when we can actually say that now it's the time for you to invest.
So how does it work? Do you basically then identify a place, you apply for it, and you basically, with what your approach would be, is to have this business or this property make more money for you? So is that how it works? This investing in property or property investment, is it a matter of identifying a space and saying, I'm buying this space, I'm working on it so I can resell it with a bigger price amount, or I'm buying this space, I want to start maybe a block of flats, or I'm buying this space. How does it work? Because we know as well that there are different spaces and different properties that you can go into, big or small, as you go into this property investment.
Yes, that's how it works, Katleho, is that we run numbers first before we even put an offer. As soon as you're done running numbers, you identify a place, and then as soon as you see it.
What is running the numbers? So actually checking what's in my account and see how much I have or how much I can afford.
So running numbers for us means that in terms of what is my return on investment on that property that I'm buying. Why do I say that we need to do that? Is that we are qualifying this house in terms of, does it make financial sense for me to buy it? So we don't buy it just for the sake of buying it. As soon as we've identified, there's two approaches. It's either I'm going to go for my banker, or I'm going to go through the bond originator route. So now the trick is, that's why we say that it's very important to get a team. Katleho, if I'm to ask you, right, if let's just say that you went to a bank and then they told you that this is the percentage. So if you are trying to negotiate, how do you know that this is the best percentage?
I think then you have to move around, right? In terms of doing comparisons. Hence, people then would say, if you are buying something, get different quotations before going for whatever. I think, won't that be the approach?
Aha, I'm happy you took that route. That's a question that I asked them during the workshop. So remember something, as soon as I go around to different banks as Newo, now that's affecting my credit score, because I'm applying to different bankers. And again, even if I am going around, like, what is that good percentage? Because sometimes I can go, let's just say that they're telling me 11. And then I go to these guys and then they give me, let's say 10.9, only to find out that with the bond originator knows that they would have went in at 9. So ultimately, hence we say
it's a
that
tricky space. So you can't just go into it blindly.
never.
Yeah, because if I can just add on, right?
Yeah.
So sometimes what they also do is that, like the example that Noah just said right now, say for instance, they're giving you 11% and then the other guys are giving you 10.9%. But with the 10.9%, they're then increasing the number of years that you're going to be paying to 30 years. And now you are only focused on the 10.9 and saying that at least I got the better interest rate, but not knowing that long term, in 30 years, you would have actually paid way more than you would if you would have taken the 11% at 20 years.
Does this apply to a property that maybe I want to stay in or I want to flip? Because the question was also twofold in terms of what are some of those different properties and how does it work from one to the next. For instance, if I want to just buy land and start building on it, or if I, for instance, I just want to buy a property that is already standing and I want to flip it, or if I just want to buy something that would actually see me having to revisit this place every month to collect cash, it's still in my name. Does it work the same with all of these different properties? What are some of those different avenues and properties that people can invest in as they go into these property investments?
Yes, it does apply even into the house that you want to live in, the house that you'll be living in. Because, and also remember again, is that even with deposit, and a lot of people don't even know this, that I can also use that to decrease my interest rates. However, now it's through the bond originator telling them that I have 100,000 and let's use that 100,000 as leverage. So they're gonna ask the bank in terms of, before we even put that 100,000 in, what is the interest, and then if we are to put in this 100,000, can we further reduce it? So hence, I truly believe in using a team, even whether it's for investment or the house that you'll be living in. We need to apply these rules.
And really, also, when you look at it, what are people curious about when it comes to this space? What did you pick up from the workshop that you can say that maybe there's still a lot of confusion around how this works? I mean, I was so confident to say you can move around and apply and get but only to find that no, man, you're actually compromising yourself here. So what are some of those, even maybe obvious things that we reckon they're obvious when going into some of these spaces that are not obvious, that you have to really think of? Because you'd hear people saying, what happens difference if maybe I buy this property on auction compared to buying this property in a way that I would approach the bank and go about it in that sense? So it's not just an obvious go-to case. As you go about these workshops, what are some of those things that you pick up and some of those that came out over the weekend during that workshop? Lebo?
Okay, so the first one I would say is that most people are buying properties through credit. And with them buying properties through credit, they do not understand in terms of how do they get ready to buy a property, looking at it from a credit perspective. So people are just thinking that I got a good job right now, let me just apply for my home loan, which is not correct, right? I would say that you need to make sure that your credit score is sitting at its best before you apply for that loan. I mean, for example, with Neo, whenever he's going to be buying a property for the next 3 months, say for instance, he's planning on buying a property before the end of the year. For the next 3 months, there are things that he does to his accounts so that he makes sure that he's going to be getting the best. So for example, making sure that he's paying down most of his credit cards. That's the first one.
So paying down is what? Maybe paying double instead of paying once. Or
exactly.
But yeah, if maybe my installment was 80 rand, I pay 160.
Exactly.
Okay.
Exactly. The reason why you do that is that if your affordability, the more credit you have, the less affordability you're going to be having. So for example, if you have a credit card that you're owing 40,000, for example, and then on a monthly basis you need to be paying 2,000 on a monthly basis. Now, if you are earning 10,000 and you're going to apply for a bond, someone earning 10,000 and is paying a monthly amount of 2,000 towards their credit card, and someone that doesn't have a credit card but they have a good credit score would be affording a property that's more than the guy that's actually paying the 2,000. Now, when you're looking at it from a perspective that credit card, you're only paying it for 5 years. Now that's going to affect the type of property that you want to buy. So you might find out that if you had paid off the 2,000, you might afford a property that's worth, let's say, plus minus 500,000. But now because of that 2,000, you cannot qualify for the 500,000. You can only qualify for 450,000, which makes you lose out on that ideal property that you wanted to buy.
Okay, Lewis being professional. What did you say is the relationship between you and the bank during the workshop?
No, what I said during the workshop is that with the credit bureau, it's a relationship whereby they want you to want them, but not want them too much. So it's just that fine balance that I want to know that you want me, but not that you really, really need me.
It's a tricky one.
So it's just one of those, man.
It's a tricky one to navigate. So would you say that then one would need to actually have credit? Because it's so weird how things happen in the country, and we've discussed this as well before, to say that for you to be able to be in good standings, you will have to have credit somehow. And you often hear people saying it's a matter of us tracking your behavioral patterns in terms of whether you are one person that is responsible or not. And does this actually probably, let's say, the 3-month rule, can it help push me up, catapult me? If, let's say, for instance, 3 months before I go to apply for a bond or anything along those lines, I start, getting my house in order, does it then erase some of the things that have been happening in the past? When does one get to a clean bill of health where the credit is concerned? When maybe you find that in the past they were in the red, or they were flagged, or even going to a point of them summons being issued or something along those lines. How does that also then affect you wanting to go into applying for a bond or investing or starting your own journey where property investing is concerned?
Absolutely, you are right, Katlego. We're like our report card. Once we're done with grade 12, it's that credit score. Like we need to protect that with our lives, because ultimately no credit is bad credit. And we do certain mistakes whereby sometimes not necessarily understanding. For instance, myself and Lebu were like, one day, maybe after 10 years right now from now, we'll release a book writing that how we bought that property with that gene, because we learned how to pay off a gene, taking another gene, and that ultimately put us to where we are right now. Like my credit beat Leo's credit score because of that sheen that I was paying on time. Whereas sometimes you might just ignore a certain gym company, forgetting that this will catch up to you later on. So the credit, as much as we might not like it sometimes, but it's something that we really need to prioritize in our lives. Because some people take credit into consideration from the age of 18. Like some families put kids down and say that I'm going to teach you. And you find out that this person by the age of 25, they have a great credit score. Whereas with me, I've never had a look at credit. By the time now I got that job, I want to apply for the house. But now I'm asking myself, but why
you're
are you
scared about skoloto? And you're like, oh, skoloto, oh my God. So it's just a tricky terrain. So, but the 3-month rule, does it work? How do you get back to a clean bill of health?
Okay, so looking at someone that had a bad credit score, it's going to be a bit of a challenge for them to get to a good side, because sometimes credit bureau does go through 2 years, right? Now, depending on the power team that Neo was talking about earlier on, say for instance your bond originator, they can actually go to the bank and explain the situation that you were going through. So for example, during COVID, a lot of people lost their jobs. A lot of people didn't have income, and therefore they were not able to pay their monthly bills. Now with a bond originator, a good bond originator would have actually went to the bank to tell them that, okay, this might have been the problem, but now let's look at the past 6 months in terms of their behavioral patterns, right? And the 6 months before that, were they actually paying good? And if so, that could be a way of them justifying. However, if you did have a bad patch, just have a conversation with your bond originator up front that this is what happened and this is how I've actually tried to fix that. So I would say that with someone that with a bad credit score, they should actually give themselves more like 1 year in order for them to fix their credit score.
Yeah.
So let's break down then the approaches. Where do you start? If I want to, I say today, I'm resolute after listening to the gents. I think property investing is the way. Where do I start? Do I start by approaching my bank? Do I start by getting a credit score breakdown in terms of understanding where I am, if I'm poor, I'm average, or I'm excellent? And how do I actually approach this? And also, what is a good credit score?
Yeah, my start would then be, before I even look at any property, it would be credit. Because remember something, it's a property that you'll be holding for the next 20 years. So if it means that I'm going to work on my credit for 2 years and get the best for the next 20 years, then so be it. So I'd definitely look at credit before I even go into the deal itself.
Yeah. Credit score, but what's the best credit score?
A good credit score, I mean, according to me, right, where we can actually look at getting better interest rate, I would look at around 670. Let's work towards pushing our credit score to 670. But sometimes it does. You could qualify.
Is it possible now?
It is.
It is
He's
possible.
there. That's why he's saying it's a good one.
But it is possible for someone to actually get a home loan, car 620. But remember, when you're applying with the minimum, chances are the interest rates will be high. So that's why I'm saying that at least with 670, you are able to negotiate with the banks in terms of you having a good credit score and being a client that is more ideal for them.
So you start there, you check your credit, then you approach the bank to initiate a bond or whatever. Start those applications.
Yes, it's the bond originator, right?
Bond originator.
Yeah.
And then before going to apply or check a property, or do I check a property, identify, and then go check if I qualify for that property?
Okay, so that's where a lot of people go wrong. Right?
Yeah.
So a lot of people, they'll first go to properties, view properties, and once they've seen the property, that's when they'll start applying, only to be rejected because of affordability. So what I would say, go to a bond originator, they do a credit check on you, and they do a pre-approval. So pre-approval will tell you that, look at this price range. So now that I have my pre-approval, I know that my maximum will be around 670. If I go above 670, then I'd need to have a deposit. Right? Now, in that way, I'm able to go into the market knowing that what type of properties should I be looking at. Because it doesn't make sense for you to be looking at properties that are 1 million only to find out that you only qualify for properties with 670,000.